But I also think it's not in their interest to do it. I mean, there's a Chinese proverb: "The wise man sits on the hole in the carpet," you know, to to basically hide the deficiency in his house. That's actually what they should do, and this actually is the policy of the U.S. Treasury. I mean, you had Scott Bessent going in saying, we're going to do we're going to look at the gold in Fort Knox, whatever. We're going to do a survey. We're going to do an audit, all that sort of stuff. Of course, as soon as he's in the Treasury, he's firmly advised, I wouldn't do that if I were you, Scott. Shut up. I showed how the gold price, if you like, moved very similarly to how it moved in Germany after the First World War. And as I'm sure most of your viewers know, that culminated in a collapse of the Reichsmark. And the collapse was absolutely total. So we should, if you like, worry about why it is that the gold price is rising on the same sort of curve, if you like, as it was in the later stages of that hyperinflation. I mean, by the later stages, I mean really from about late 1921 onwards. And I mean, the answer to this is quite simple, and that is that the dollar is, if you like, in the early stages of its final life as a fiat currency. Fiat currencies always come to an end. And the reason they come to an end is that governments, the issuers, if you like, of fiat currencies, use them to supplement their taxes. And it gets to the stage where the debt is built up to such an extent that the whole thing eventually falls over. And that's roughly what we face with the dollar. And of course, because we have a global fiat currency system based on the dollar, it affects all of us everywhere. Your reference to 1929-32, of course, it was the big Wall Street crash, the bear market after the roaring 40s, roaring 20s, sorry, when you had a similar credit bubble, but this one is far bigger. Also, you had the Smoot-Hawley Tariff Act, which imposed extra prices on imported goods. This time, we've got the uncertainty because a capricious president keeps on changing the numbers. But there is no doubt that the combination of a credit bubble and trade tariffs at the top of that bubble is a lethal combination. This credit bubble will pop. And the reason that we can see that the end of the fiat currency dollar is approaching is because we know what the response to the authorities will be when that bubble pops. Because a popping bubble basically means there's more risk in credit, which means that bond yields will rise, borrowing costs will rise for anyone borrowing overnight or whatever. It doesn't matter what the Fed says that the funds rate is. I mean, that's completely immaterial. But, markets look at risk and they have to price that risk, and they will price that risk in the knowledge that the purchasing power of the dollar is falling because that debt is being monetized. It's actually already being monetized because the Treasury is relying increasingly on the issuance of T-bills to fund its deficit, because the cost, if you like, of funding at the long end of the yield curve is just too great for it. And, it's also found that there isn't really the demand out there along the yield curve, if you like, to support the level of financing. I mean, you've got the deficit, and also you've got all the maturing debt, which has to be rolled over. So, there's substantial refinancing problems there. And it's being monetized is really what it boils down to. This is very, very bad news, already being monetized. And then this week we had the Fed turning around and saying, no more QT, now it's going to be QE, and we're going to knock a quarter point off the Fed funds rate. So you can see that the Fed has switched from trying to manage the inflation problem to trying to stop the economy from sliding into recession. So put all that together, you can see how, the ghosts, if you like, of the Reichsbank are on the stage now.
Every currency built solely on trust eventually reaches a point where debt overwhelms that trust. Nations often print to cover spending when taxes fall short, and over time, the weight becomes unbearable. The US is now confronting precisely that moment. Trillions in deficits, endless refinancing demands, and shrinking global appetite for American bonds signal a system stretched to breaking. Whether the Federal Reserve raises rates or cuts them, confidence erodes. Because the dollar anchors the world's financial architecture, its decline sends shockwaves everywhere. The end of a fiat era doesn't happen quickly, but once visible, the timeline accelerates fast.
Bear in mind that the current cohort of economists, bankers, investment managers, whatever, are all trained in macroeconomics, which basically is Keynesianism. And so they don't actually understand economics. I mean, the whole of the Keynesian thing is a myth. It really is. It cuts out human action. And the idea that you can calculate and project from statistics exactly what the outcome will be is arrant nonsense. I mean, it really is. But they all, they don't have any substitute for that. That's the problem. They don't actually understand the legal position of gold either, because gold has been denied as part of the fiat dollar-led system for 54 years. But the fact of the matter is that gold is everyone's money, if you like, without counterparty risk. And it's embodied in everybody's common law. So, this is the idea that gold is just a pet rock now, or, whatever they like to call it, is just pure propaganda. And of course, everybody's fallen for it. So there's a huge, great re-education, not just of politicians, but of their advisors, which is necessary before they can really tackle the current problem.
History shows that massive credit expansions create illusions of prosperity until reality arrives. In the late 1920s, speculation and trade barriers collided to collapse markets. Today's bubble is far larger, built over decades of cheap money. And now, rising risk forces borrowing costs upward, regardless of official rate targets. The moment lenders fear repayment, markets reprice everything. Governments respond in the only way they can. They monetize the debt. More money, less value. The Federal Reserve's recent pivot back toward stimulus confirms what they fear most: recession, not inflation. But delaying the reckoning only multiplies its force.
I mean, basically, nowadays we sort of look back on the events of 1933 when FDR decided to, if you like, ban the ownership of gold, putting it very, very bluntly, and forcing individuals who held gold to swap it for dollars at the current gold standard, which at that time was $20.67 to the ounce. I mean, the point about it is that what he did was actually a clever way around property rights. Property rights are sacrosanct in an economy like America's. But at that time, we had an absolutely solid gold standard, which was de facto from, I think, about 1856, and de jure from the Gold Act in 1900. So there's absolutely no question that the dollar, at $20.67 was the equivalent of an ounce of gold. I mean, it was just absolutely simple. So using that basis, he forced everybody to exchange their gold for dollars. There was no confiscation. It was just an enforced swap, if you like, of property. So, of course, I mean, the fact that he subsequently devalued the dollar by 40% in 34 was, is a separate issue. I mean, that undoubtedly is what he had in mind when he forced everybody to submit their gold. So you can see that, it's a sort of, if you like, it's a bit of legalese, really. I mean, the effect was the confiscation of gold, but in legal terms, it wasn't quite if you see what I mean.
Mm-hmm.
I think it does actually inform us today. Would America do that again to its own citizens? I think not. I mean, the problem is that the gold standard, believe it or not, is at $42.22 to the ounce. So quite obviously, if the market price is $3,900 or whatever, and you're forced by executive order to exchange your gold at the rate of 42.22 to the ounce, that is actually definitely, um, stealing your property. I mean, or stealing the value of your property. Anyway, so one way and another, I don't think it's so easy to do now. I know everybody thinks that, once bitten, twice shy, this has happened before, and therefore it might happen again. It might happen again. I mean, bear in mind that, we could be talking about legal niceties when it comes to the future of gold ownership. So, these clever guys would probably find some sort of way to do it if they really were determined to do it. But I also think it's not in their interest to do it. I mean, there's a Chinese proverb, the wise man sits on the hole in the carpet, to basically hide the deficiency in his house. So that's actually what they should do, and this actually is the policy of the US Treasury. I mean, you had Scott Bessent going in saying, we're going to do we're going to look at the gold in Fort Knox, whatever. We're going to do a survey. We're going to do an audit, all that sort of stuff. Of course, as soon as he's in the Treasury, he's firmly advised, I wouldn't do that if I were you, Scott. Shut up. You have to ask yourself why. It's a sort of question of shut up. I mean, there are two possible answers to this. The first is the obvious one that, the official line has been that gold is now a pet rock. It's got nothing to do with the monetary system, so don't talk about it. That's one option. The other option is that actually there is likely to be a deficiency in the quantity of gold. So the report that they've got, 8,130 tons, or whatever the current figure is likely to be incorrect. And it's not just because it hasn't been audited properly. I mean, you have to bear in mind that really from the sort of early 80s, when the LBMA really started going, gold was the basis of the carry trade in order to buy US T-bills. And so, you would go and lease gold, say, from a central bank, sell it into the market, apply the proceeds to T-bills, and so your cost of funding was roughly 1%, and the return you were getting was up to 10%. And you leverage it up if you can, absolutely. I mean, this is a brilliant trade. But what happens to the gold? It goes into the market. Does it ever come back? Well, not really. That's the trouble. And Frank Veneroso, who is the analyst who did most work on this, he was also talking to people I knew in the old days, like Terry Smeaton at the Bank of England. I mean, his sources were top flight. They really were. He reckoned that somewhere between a third and a half of all central bank gold had gone out on lease and probably disappeared, if you like, not returned. So what you have, I mean, if you open Fort Knox, you'd probably find a whole bunch of IOUs sitting there rather than the real stuff. And of course, the other problem is that we wonder why it was that the Federal Bank of New York, which basically stores earmarked gold for foreign central banks, was so reluctant to return as little as 300 tons of the Bundesbank's gold to it. What was it, 10 years ago or 7 years ago, whenever it was. There was and not only that, but they wouldn't let the Bundesbank look at its own property. They were denied the right to go and have a look at their gold, to check serial numbers and all the rest of it. Oh, no, can't do that. So, there's definitely some skullduggery going on there. I think that's the other reason, basically, why every Treasury Secretary is told, shut up, don't talk about it, off limits.
Modern economists trained in Keynesian thinking often dismiss gold as outdated, a superstition of the past. But gold has never needed trust. nor a central bank proclamation. It carries no counterparty risk. That is precisely why governments have spent decades pretending it doesn't matter. Yet the moment faith in paper falters, gold returns as the ultimate settlement tool. The US once forced citizens to surrender gold, a move not labeled confiscation, but a mandatory exchange. Today, financial and legal structures make such actions far harder to justify. Gold reveals the truth about monetary mismanagement. That's why silence surrounds it.
I think it's a very difficult question to answer because there are a number of legal hurdles to overcome. I mean, cash is not subject to capital gains tax, if you like. If it was, we'd all be claiming it on the basis of its loss of purchasing power, if you could establish that. But I mean, this is a difficult one. I cannot actually rule it out, but I think it would be a very stupid thing to do, certainly from the point of view of the Treasury. I mean, I can't think of any more effective way of showing your bankruptcy, but by applying taxes on legal tender. I mean, this is something which I think. I mean, we were looking at sort of some pretty arcane law here. So, I don't know whether it would be possible. Might be possible. I don't know. But I mean, they've introduced VAT, for example, on silver coins. So, but that was not a UK thing. That was actually an EU thing. And now after Brexit, we didn't change that. Guess what? So, and I think also, really from the sort of central banking network, the idea of doing that, I think, actually would ring alarm bells, not just in the UK, but all around the world. It really would, this idea of taxing. I'm probably grasping at straws, and I wouldn't be able to really deny that. But I think it's unlikely, but not impossible. But the great thing about it is, how do you collect it? Because a sovereign or a Britannia is bearer money, if you like. It's cash, and you can't establish that anyone's actually owns it. I mean, I could hand my sovereigns over to my children, if you like, and I should declare that, if you like, to the Inland Revenue as a gift or whatever. But if I didn't do it, I think they would have almost no means of checking it out. They really wouldn't be able to check it, because it's not. We're not talking about ownership evidenced in paper form, in contract form. We're talking about it's if you like, as untraceable as a bundle of pound notes.
For years, central banks leased gold into the market to earn yield, selling physical bars while keeping IOUs on balance sheets. Analysts believe a significant portion never returned. When Germany requested a fraction of its gold back from New York, delays and restricted access raised questions many prefer unanswered. Even audits of America's own reserves remain off limits. Two scenarios explain the secrecy. Officials either want gold forgotten, or the vaults hold far less than reported. In a system already strained by debt and distrust, the integrity of sovereign gold reserves may soon prove decisive or destabilizing.
And when you see, the LBMA attendees at the annual Beano reckon that they all came up with their forecast for 2026, and the average was just under $5,000. So you can see that people are now talking it going higher, but they don't understand why, quite frankly. I mean, it's, as you said in the introduction to this, in another article I wrote, how people sort of think, well, it's a bit of unwinding of speculative positions, and you've got a bull market that pauses and so on. But it's not a bull market in gold. This is the whole point. It's actually a bear market in currencies. You've got to look at the other variable, if you like, in any pricing, and that is the currencies. The currencies are going down. Now, nothing happens in a straight line, we'll admit that. But basically, if you want to trade this, then your life is in your own hands. And if you want to trade it, basically you're up against some very big people with very deep pockets. Little old you will get wiped out, I can assure you. So this is not a market for trading. It really is not. I mean, you can go to bed at night and say, oh, I've got a nice little profit. You wake up in the morning and find they bashed it. Why they bashed it? Well, it's got nothing to do with fundamentals or anything like that. It's got to do with book positions. And if they think they can shake you out, they will do so. So by the same token, I don't get in the business of making price forecasts. All I can do is I can tell you why things are moving, not how far they're going to move at any one, in any time frame. But stackers should be rejoicing. I know what will happen. Most small people, but I don't mean that in terms of stature, but I mean that in terms of funds, will be, they will be disillusioned if they see the gold price fall back to, say, 3,600 or 3,500. Well, the answer is that basically nothing has changed at all. Governments are being horribly irresponsible. Their situation is getting worse. I guess that the moment will come when that credit bubble pops. When the credit bubble pops, you start seeing equities falling, you start seeing bond yields rising. And at that time, I don't know, I mean, if you're terribly worried, you might sell some of your gold because you're not thinking in terms of final settlement and credit. It's credit where the risk is. If you sell gold, you're buying credit. Do you really want to do that? No, this is, I mean, I think that the right attitude to take is, a setback like this is a gift for stackers, a gift for people who perhaps might have missed the boat a bit. They need to get in and protect themselves. This is a time not to sort of speculate to accumulate, which is the attitude. It's a time to protect what you've got. That's as simple as that.
The true story isn't a gold bull market, it's a global currency decline. Governments keep creating new money to solve problems caused by too much old money. Markets may swing, but the direction of trust is one way. Those trading gold like a stock risk losing to powerful forces defending the status quo. But those holding gold hold certainty when uncertainty erupts. When credit cracks, banks fail, and political promises prove hollow, gold does not default. This moment isn't about speculation or getting rich. It is about protecting purchasing power as the financial system enters its most fragile chapter in a century.